Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Thursday, December 4, 2014, daily chart of the SPY. And at the end of the day, nothing happened today. The S&P was down 2.5 points. The Dow was down 12.5 points, and the NASDAQ was down 5. So that's a nothing day. That's basically a break even in my book. So where are we? I still say that we're going to get a kind of a swift pullback. Maybe it happens tomorrow. We kind of almost had the beginning of it today, and here's kind of evidence that it's coming, right? You had a gap down a little bit, and the S&P went down, and then, around that lunchtime, 11 o'clock, 12 o'clock time frame, you kind of carved out a bottom, and then you rallied back up and tried to sell off again at the end of the day and rally back up again. So basically what that's telling you is that the buy the dip mentality is still there. And even if, and tomorrow's probably a decent day for the S&P to try again to sell off. Why? Because we have the phony jobs number, right? So, and I don't mean to call it phony, but it is phony because they come out with a number of, jobs gained for the month, and it's going to be 200, 212, 225. They don't know what it is. It's nonsense. There's no way for them to know what it is. They claim it's a survey. Nobody in the history of the world has ever gotten the survey. So I think it's a made-up number, but that's besides the point. It doesn't matter. The point is that the market will react off the number. And whatever the number is and whatever the market does, it will be because of the number. And if tomorrow we sell off, we may have another day or two of a sell-off, but I'm telling you that you can buy the dips here. And even if the sell-off is 20 or 30 S&P handles, okay, which would be, 2-3 points down on the SPY, so that would bring us down here, down to 205, 206. Where are we now? 207.5. So maybe 205, 204, something like that. If that happens, well, let me go to a daily chart, and it's easier to see. Okay, so if we go down here, there's a lot of chart support here. That's a possibility, and if we do, you can probably begin to nibble away and buy the dips, because at this point, I don't see us going much below F at all, even reaching this number here at 202 that I've been talking about. And the reason being is the farther we get into the month, the less likely it is we're going to see a sell-off in the month of December. And I still say we see, a day to 2 or 3 of a pullback, but that's all it's going to be is a pullback, and it's a buying opportunity for sure, because the buy the dip mentality has not gone away, and it's not going to go away this month. Therefore, if you get any kind of a down move, and here I am telling you to buy the dips, buy the dips. You got to pick a list. And I have a list that the members will begin to get over the next day or two if the market does begin to pull back. And, there'll be a day in there where the S&P is going to be down 20, 25 points. And it's going to scare everybody, and they're going to start talking about, oh no, here comes a sell-off, the economy's contracting, Russia, Ukraine, Japan, this, that. They're going to come up with any excuse in the book. The oil hedge fund will fail. I've been talking about that. Whatever it is, whatever the story is, it's only going to last a couple of days, and then you're going to see a snapback. So even if you don't catch the bottom, which you may not, don't be scared of it, because a couple 3 days later, you're going to find the market right back where it came from, and then it's going to go higher, and we're going to make new highs into the end of the year, and that's going to be that. And so this is definitely a buying opportunity if the market pulls back. And by the way, if the market doesn't pull back, it's still a buying opportunity into the end of the year. And that's the way it's going to be. Okay, when January comes, we'll talk about January. We will see pullbacks next year in earnest, but right now it's not here, it's not coming. You're hearing stuff like the Hindenburg Omen, and all that stuff happened, I think 2 days ago, and then it was invalidated yesterday, and maybe it was revalidated today, and that has to do with highs and lows in the same day, and the McClellan oscillator, and the Lupinacci vector, and whatever it is, it doesn't matter. All that stuff's nonsense. Every year you get a handful of Hindenburg Omens, and everybody comes out and says, oh no, there's a Hindenburg Omen, which means we're going to have a crash. No, it doesn't. It's not going to happen right now. There's going to be no crash right now, and that's the end of it. So don't be scared to buy a dip. and we'll just take it from there. Take it one day at a time. And by the way, if we're wrong, you'll know you're wrong right away. But it's not going to be wrong. So that's where we are. Let's just take a look at the IWM, which was down a little bit more than the S&P today, but not much. But one thing to note here is that the IWM, while the S&P has made new highs and continues to do so, the IWM hasn't reached this high from July yet, right? High, lower high. Okay, we did take out the high over here, and this is relatively bullish consolidation, even though we'll probably see a pullback maybe to this 200 period or the 50 period moving average. Much below that, I'm not sure. We'll see that. If we do go below that, I would look for 111 as a stopping point. And if we get down there by chance, okay, because the IWM will be more aggressively volatile than the S&P when we do get the day or two or three pullback, okay, so it will sell off more than the S&P. It normally does. And if that happens and you come down to this gap fill right here at 111, buy it. And that's the end of it, okay? That's a good buy level. Even if I'm wrong by a point or two, it'll still snap right back into the end of the year. And do I think we'll make new highs in the IWM before the end of the year? I doubt it, but it's possible. We could. But, you know, we're still going to be back up here before the end of the year or higher. So there's your IWM. Let's go over to oil. And here's the USO, okay, if I can get the chart going. All right, so here's the USO. And you know, it's still very weak. And, you know, you may see an uptick in oil, but all in all, it's still weak. And that's why I'm tying this together with that hedge fund failure story because, you know, like I said the other night, they're leveraged and there's got to be hedge funds out there teetering on the precipice of collapse. So that would cause some pressure on the market because they'll have to liquidate whatever positions they have left, and that'll put pressure on the market because there could be a hedge fund that's a multi-billion-dollar hedge fund that fails. It's very, very possible. So anyway, with oil, and this is the USO, it's just very, very weak still, and there's nothing to do here. There's just no sign that you have a bottom here. Look at this big, wide, red bar going down. That was from the OPEC meeting, after the OPEC meeting on Thanksgiving. That was what caused this down move for the week. And, you know, there's just nothing going on here that looks good. Let's even go to the longer term chart. You have to see a reversal. You have to see a high volume reversal day. At this point, okay, on the USO, I would suspect that you're going to see a double bottom here in the USO back from 2009. Okay, this is February of 2009. This is March of 2009. These are close enough. Anywhere in this area, if you came down here, I think you could buy it for a bounce. But, you know, to say it's going to be a long-term buy, A, it's too premature now, and B, I just don't know if that's viable at this point. So, but, you know, you will see some upside in the USO eventually because it's, you know, way overcooked here, but it's still very weak, and I wouldn't be playing the USO or the oil, particularly oil market, until you see a high volume reversal day. And this kind of looked like it, but it never really panned out. And it was high volume. It was an engulfing candle, but at the same time, it really wasn't a reversal day because we just have been going sideways. So you would have had to see follow through the following day, and we didn't see it, so it doesn't count. But when you do see it, you know, where's the upside? You know, it's hard to say, but, you know, I don't see us getting anywhere past the 50-period moving average, which is downsloping right now. So right now it's 30.5 roughly, and that's going to continue to move lower. So even if we did get a really good rally to kind of throw out the shorts that are still in there, and you have some short covering, and then you have some pile-on buying, if that happens, you know, this is probably your top level anyway. And, you know, that's the end of it. So we'll see what happens, but this is a long way off, folks. I mean, this is 20% from here, right? I mean, that's not going to happen anytime soon. And even if it did, it would take several days to work out. And if we saw a high volume reversal bottom, okay, you'd be able to hop on and ride it up anyway. You don't have to catch the bottom. Let's go over to the gold market, and here we go. The gold market is in really good shape, okay? Unlike the USO or unlike oil, the gold market had this big big day here, this big up move. Okay, this was from the 1st of December. Okay, this was the day when the gold market itself spot gold was down at 11:30 overnight. I'm sorry, 11:41 or 11:40. I think it was 11:41 overnight. And then you finished the day at 12:15 or 12:20, some ridiculous number like that. So it was an enormous move. It was basically like an $80 intraday swing from the overnight session all the way through the end of the day. And that tells you that price is moving higher. Now you're hovering above this 50-period moving average, this blue line here, and another couple of days like this, and you'll probably shoot higher again, and you're going to start to challenge this area, this gap fill here, and then this pivot high here at 120.5. And then I still think there's higher prices to be had from there, but you'll probably stall out and do this again. You'll go up, you'll consolidate, right? So then you'll go up, you'll consolidate. And what do we always say? We have the A, the B, and then the C. So right now you're kind of putting in that B, okay? And then we'll have a C up, and then maybe we'll do it again. But right now, gold is a buy. You know, even if it pulls back, you buy it here and it pulls back, there's numbers that we don't want it to close below, and the members got those numbers yesterday. So I put them out, and they know what they are, so that you have something to trade against. And if you have something to trade against, you know where you're wrong, and you can move out, right? You're not going to win every trade, but as long as you have the probabilities on your side, you can buy something like gold, and you can play it for an up move. So that's where we are in gold. I think that's it for tonight, folks. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.